The 7 psychological pitfalls destroying crypto investors. Why do smart people lose money in crypto? Not because they're stupid, not because they got scammed, not because they picked the wrong coins. They lose because their own psychology is working against them. You can avoid every scam, you can do perfect research, and you'll still lose everything if you don't understand the psychological traps that destroy investors. By the end of this video, you'll understand the 7 mental pitfalls that wreck portfolios and how to rewire your thinking to survive. Because the market isn't just testing your analysis, it's testing your psychology. Hit that subscribe button right now. I break down the mental traps and scams designed to exploit your emotions every single week. The difference between successful crypto investors and failed ones has almost nothing to do with intelligence. The difference is emotional control, because crypto is a psychological battlefield designed to exploit every weakness in human decision-making. 24/7 trading, extreme volatility, constant information flow, Twitter amplification, Discord hype, FOMO, fear, greed. Every emotion you have is being weaponized against you, and these psychological traps don't feel like traps. They feel like logic. They feel like the right decision. So let me show you the 7 psychological pitfalls. Be honest with yourself. How many have you fallen for? The first trap is loss aversion. Humans feel the pain of losing money about 2.5 times more intensely than the pleasure of gaining the same amount. You buy a coin at $1. It drops to 50 cents. You're down 50%. It hurts. So you hold. Because selling would make the loss real. Meanwhile, another coin pumps from $1 to $2. But you don't buy it, because all your capital is stuck in your losing position. Loss aversion keeps you holding losers and prevents you from taking new opportunities. Professional investors cut losses quickly and let winners run. Your brain is wired to do the reverse. Look at your portfolio right now. Which positions are you holding just because you don't want to accept the loss? The solution? Set stop losses before you enter a position. Decide in advance at what price you'll exit. Then follow that rule. The second trap is confirmation bias. Once you buy a coin, your brain filters information to support that decision. You notice every positive tweet, every bullish article, but you ignore every warning sign, every red flag. Your brain is protecting your ego from admitting you made a mistake. Here's a real example. Someone buys at $10. It drops to $5. They find an article saying it's undervalued. They buy more. It drops to $2. They find a tweet about upcoming developments. They buy more. It drops to 50 cents. They find a Reddit post saying it's the bottom. They buy more. At every stage, they found information that confirmed their belief. And at every stage, they lost more money. Before you buy your next coin, write down 3 reasons why it could fail. The solution? Ask yourself, if I didn't already own this, would I buy it today at this price? If the answer is no, sell it. The third trap is anchoring bias. Your brain latches onto the first piece of information and uses that as a reference point. In crypto, the most common anchor is your entry price. You buy at $1. It pumps to $5. You're up 5x, but you don't take profit because you saw it hit $7 last week. That $7 is now your anchor. So you hold, waiting for 7. It never comes. It crashes back to $2. You still don't sell because your anchor is 7. Eventually, it crashes back to $1. You've made 0 profit on a coin that went up 5 times. Delete your entry price from your mind. The only question that matters is, what's the probability this goes up versus down from here? The solution: if you wouldn't buy it today at the current price, you shouldn't hold it. And if you're finding this valuable, hit that like button and subscribe. Next week, I'm breaking down the biggest Ponzi scheme in crypto right now. The fourth trap is herd mentality. Your brain is wired to follow the majority. A coin starts pumping. You see it everywhere on Twitter, Discord, or Telegram from groups you are in. Everyone's buying it. Your friends are buying it. Your brain interprets this as safety in numbers, so you buy. Right at the top. Then the crash comes. Everyone's panicking, everyone's selling. Your brain interprets this as danger, so you sell, right at the bottom. You just bought high and sold low because you followed the herd. The next time you feel the strongest urge to buy because everyone else is buying, wait 48 hours. The solution? Make decisions based on your own analysis, not on what everyone else is doing. The fifth trap is recency bias. Your brain gives more weight to recent events than to historical patterns. In a bull market, everything goes up. Your brain starts to believe this is normal. Everything always goes up. Risk doesn't exist. So you get more aggressive, you use leverage. You invest money you can't afford to lose. Then the bear market comes. And you lose everything. The reverse happens in bear markets. Everything goes down for months. Your brain believes this is permanent. Crypto is dead. So you sell at the bottom, right before the next bull market starts. Go look at a Bitcoin chart from 2013 to now. Count how many times it looked like crypto was dead. Count how many times it recovered. The solution? Understand that crypto moves in cycles. Bull markets always end. Bear markets always end. The sixth trap is the sunk cost fallacy. Your brain becomes irrationally committed to an investment, even when all evidence says you should quit. You bought a coin at $10. You did research. You told your friends. You've been holding for a year. Now it's at $1. The team hasn't delivered. The roadmap is delayed. The community is dying. But you don't sell, because you've already invested so much. Selling would mean admitting all that time and money was wasted. So you hold. And it goes to 10 cents. Then 1 cent. Then it gets delisted. Look at your portfolio. Which coins are you holding just because you've already invested so much? Those are your sunk costs. They're gone. The solution? Evaluate every investment as if you're making the decision fresh today. Only consider future probability. The seventh and final trap is overconfidence bias. After a few winning trades, your brain believes you're smarter than you actually are. This is especially dangerous in bull markets. You make money on several trades and attribute it to your skill, when really it was just the market going up. So you get more confident. You take bigger positions. You use more leverage. Then you make one bad trade. But your overconfidence tells you you're right and the market is wrong. So you hold. And that one trade wipes out months or years of gains. Write down your last 10 trades. How many were winners because of your skill versus because the market was going up? The solution? Stay humble. Keep position sizes reasonable. Never risk more than you can afford to lose. And if you haven't subscribed yet, subscribe and turn on notifications. So those are the 7 psychological pitfalls. Loss aversion, confirmation bias, anchoring bias, herd mentality, recency bias, sunk cost fallacy, overconfidence bias. You can't eliminate them, but you can recognize them. Here's how you protect yourself. First, write down your rules before you invest. At what price will you take profit? At what price will you cut losses? Write it down when you're calm. Follow those rules when you're emotional. Second, keep a trading journal. Write down why you're making each decision. Third, take breaks. When you feel emotional, step away. Never make important decisions when you're feeling extreme emotions. Fourth, reduce position sizes. The smaller your positions, the less emotional you'll be. Fifth, study your mistakes. Every loss is a lesson. The market will always try to exploit your psychology. But if you understand how your brain works, you can build systems that protect you from yourself. Because in crypto, your biggest enemy isn't the market. It's the person in the mirror. The goal isn't perfection. The goal is awareness. Once you understand these psychological traps, you'll start seeing them everywhere. And that awareness is what separates successful investors from everyone else. So here's what I want you to do in the next 24 hours. First, go through your portfolio and identify which psychological trap is keeping you in losing positions. Second, write down your investment rules, entry criteria, exit criteria, position sizing. Third, start a trading journal. Document your next 5 trades and why you're making them. Do these 3 things and you'll be ahead of 99% of crypto investors. And if this video just saved you from making an emotional decision that would have cost you thousands, hit that like button. Now, if you want to go even deeper into protecting yourself, I've created a complete guide on the most common scams and how to avoid them. Click this video right here to watch it. And make sure you're subscribed with notifications on, because next week I'm exposing the wallet drainer scam that's stealing millions right now. I'll see you there.